to the statement of financial position. The statement of financial position is simply a list of all the assets owned and all the liabilities owed by a business as at a particular date. As you can see on the screen, an asset is a present economic resource controlled by the entity as a result of past events. An economic resource is a right that has the potential to produce economic benefits. There are two types of assets, non-current assets and current assets. And equity. Equity is the residual interest in the assets of the entity after deducting all its liability. And a liability is a present obligation of an entity to transfer an economic resource as a result of past events. There are two types of liabilities, non-current liabilities and current liabilities. And as you can see that assets must equal equity at liabilities. Yeah, and it's a sample of a balance. Yeah. And the purpose and uses. A balance sheet. It provides a list of assets and liabilities, classified as current and non-current and equity. It shows types and assets and liabilities and can be used to evaluate liquidity and long-term solvency. Assets will include current assets, such as cash and assets expected to convert to cash within 1 year. Examples include cash, receivables, prepaids, inventory, and short-term investments. Investments and funds, non-current, not directly used in operations. Property, plant, and equipment, intangible, long-lived, and used in operations. Intangibles, no physical substance, long-lived, and used in operations. Other non-current assets. The components of liabilities include current liabilities, the obligations to be satisfied with current assets, and long-term liabilities as obligations to be satisfied beyond 1 year. Equity is the difference between what is owned and what is owed. Current liabilities are expected to be settled or liquidated. Current liabilities are expected to be settled or liquidated in the ordinary course of business during the longer of the next year or the operating cycle. Generally speaking, current liabilities are expected to be settled or liquidated within 1 year from the balance sheet date. The following are the major categories of current liabilities. Accounts or trade payables for items entering into the operating cycle. For example, materials and supplies used in producing goods or services for sale. Other payables arising from operations, such as accrued wages, salaries, rentals, royalties, and taxes. Unearned revenues arising from collections in advance of delivering goods or performing services, like ticket sale revenue. Other obligations expected to be liquidated in the ordinary course of the business during the longer of the next year or the operating cycle. These include short-term notes given to acquired capital assets, payment on the current portion of Syria, bonds, or other non-current debt. Long-term obligations that are or will become callable by the creditor because of the debtor's violation of the provision of the debt agreement at the balance sheet date. Possible obligations for warranties, guarantees, and estimated returns. Current liability do not include short-term debt if any entity intends to refinance them on a non-current basis and demonstrates an ability to do so. The ability to refinance may be demonstrated by entering into a refinancing agreement before the balance sheet is issued. Non-current liabilities mean long-term liabilities are those not qualifying as current. The non-current portions of the following items are reported in the section of the balance sheet. Non-current loans and bonds, or leases liabilities under finance and operating leases. deferred tax liabilities arising from interperiod tax allocation, obligations under product or service warranty agreements, deferred revenue, advances for non-current commitments to provide goods or service. Equity represents ownership interest in a firm. Owners of corporations are referred to as stockholders or shareholders. The following are the major items of equity: capital contribution by owners, par value of common and preferred stock issued, and additional paid-in capital. Additional paid-in contributed capital, APRC, is the amount received in excess of par value at the time stock was sold. Retained earnings is accumulated net income not yet distributed to owners. Dividends can be paid and retained earnings has a balance. A payment in excess of this balance is a return of capital, not a dividend. Occasionally, the board of directors restricts retained earnings to prevent payment of dividends. The usual reason is that the board plans to reinvest the earnings in the business. Treasury stock is the firm's own stock that has been repurchased. It is reflected in shareholders' equity as the contra account, which reduces the balance of the related account. Accumulated other comprehensive income or comprehensive income items not included in net income. And now, the limitation of statement of financial position or balance sheet. It does not represent the market value of the entity. Many assets and equity issuances measure at historical cost. Some assets require remeasurement, which are subjective, dependent on a specific fact and circumstances of that situation, making comparison difficult. And estimates may be used in preparation of the balance sheet. There are some equations. Assets equal liabilities at equity. Equity may include introduced at capital at earning profit minus drawings. Net assets equal assets minus liability. And change in net assets equal introduced capital at earnings profit minus drawing.